the Financial Survival Network, helping you to survive and thrive in the new economy. Get your free financial survival toolkit and find out where to buy gold and silver safely at great prices. Sign up at financialsurvivalnetwork.com. This is the Financial Survival Network.
1490 WGCH. This is Kerry Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold since 1990, and I'm a customer because when you buy, they ship. To find out more, go to milesfranklin.com or call them at 800-822-8080 and get a free quote. $14.90 WGCH. This is Kerry Lutz. You're listening to the Financial Survival Network. With me now, Jordan Roy-Byrne of thedailygold.com. We're talking about the price of the metal and how it's not reflected in the stocks. If the stocks went down anymore, they'd basically shut the mining sector down, but we don't think that's going to happen, and that's what Jordan writes about. Jordan, welcome back to the financialsurvivalnetwork.com.
Hey, Kerry. Thanks for having me back. It's a real pleasure.
Hey, likewise. It's been too long. I apologize. We have been swamped. We were over at Freedom Fest in Vegas. We've been interviewing like demons here, but you've been watching this market, and you said it's kind of become amusing at this point, right?
Well, it's become amusing how I think in the larger picture, just how, I mean, we all like to watch the day-to-day action because we're invested in it, both personally and professionally. And given the constant news flow and how communications have made it so easy to get information so quickly, that essentially has shortened the time span for watching these markets. I mean, everything is focused on the intraday and even the intra hour or the intra minute with high frequency trading. I guess the point I'm getting at is because of that, it's so difficult for even professionals to focus on the larger picture, and so we kind of our expectations, we kind of maybe expect everything to happen so quickly when it takes time for a lot of trends to pause, correct, and then reemerge.
Yeah. Hey, well, and when do you think that's going to happen?
Well, I think that's what we're seeing in gold. I mean, gold essentially, if you go back to 2009, let's go back to 2008. It had that big rally from about 700 to 1,000. Then it had a pretty good 6-month consolidation. But since that point, right above 900, it ran kind of in the summer of 2009 up to about 1,900. So it basically moved a little bit more than 100% in a 2-year period without any real major multi-month correction or consolidation in that period. So essentially what we've seen since the end of last summer, gold has been consolidating, and it tried to break below 1,500 or so at the end of last year, at the very end, and then it tried again at the end of May, and it failed to do so. And even in June and earlier this month, it looked like there was a chance it could break a lot lower. And so what we've seen in the last month or two is the market, it looked like it should break lower because it failed to rally. But I mean, I'm kind of sounding redundant here, but it looked to me like there was a point in time gold was going to break lower and kind of, shoot to a bottom, a capitulation type move, but we didn't get that. So in my opinion, when the market should have broken lower, it did not. So that was kind of showing strength and showing that the selling pressure had died down. Now, the reason we haven't gotten a V-type bottom is because sentiment is very, very negative, and a lot of people are not ready to jump back in immediately. So we've seen a lack of selling and a lack of buying But in the last couple weeks or so, the buying has started to pick up again, and I do think we've made a bottom. And I think going forward, it's just going to take several months for this market to really get going again. I mean, the market, you have buyers and sellers interacting, and we did have a sharp move up to 1900, and so it takes time for the market to digest that move. And I think we've definitely seen the worst. We've probably hit the bottom, but that doesn't immediately mean we're going to go back up to 18 or 1900. I certainly think we're probably going to head back up there at some point in the next 3 or 6 months or so. But as far as the next couple weeks or the next month, people just have to be patient and look to add to your positions on weakness.
And that always makes sense. And God, there's been so much weakness, huh?
Oh yeah, definitely. And again, the market it's taken quite a while for it to form this bottom. I mean, we did have this bottom, I think, in May in both the stocks and gold, yet we're 2 months past that point and the market hasn't made that much progress. So it kind of goes back to what I was talking about before. At sometimes, if markets are bottoming, most of the time they tend to have a V bottom, but other times the bottom can take many months to develop, where it just sits there and there's a real lack of both buyers and sellers. And so I think that's kind of what we're seeing here, though the buying is starting to slowly gain the upper hand, and I would expect that to continue for the next month or two.
Yeah, and we've got this nice chart, which we're going to put in the show notes, showing the holdings of GLD as opposed to the price of gold. What's your take on that?
Well, this is a real excellent chart because it can be used as a sentiment indicator for the retail crowd, supposedly the dumb money, and those are the ones that like to partake in GLD. And if you look at the holdings in GLD, and that's just telling us, essentially, how much supposed gold is in the GLD. And so when you have that, and then you have the actual price of GLD, which is, a derivative of the price of gold, but, it does follow gold very well. And so in regards to the holdings, you can have a lot of retail money going into GLD, but you can have gold fall because there's other players in the market. There's other instruments they can use to buy gold, futures and so forth, and physically backed ETFs. But anyway, what we've seen in the last month or maybe even month and a half is we've seen a sharp decline in the holdings in GLD. Like, it's come down from, looking at this chart, it's come down from about 1,280 tons or so, and that's come down to presently about 1,200 and about 50 tons. And so that doesn't sound like a big drop, but when your listeners see this chart, they'll be able to understand what we're both looking at here. And so essentially, we've seen kind of a significant decline in the holdings in GLD in the last month or so, yet at that same time frame, gold has actually trended higher. So in other words, we see retail money has started to panic a little bit out of their GLD positions in the last month, yet the gold market has actually, not only has it not moved lower, it's actually moved higher. And so, I mean, looking at all these things, to me, it really cements the fact that the market has bottomed. And you could also say that it's really the smart money and the professionals that have been buying in the last month.
Yeah, and the smart money is always going to be there ahead of the retail or dumb money, because the smart money is smart for a reason, and the dumb money is dumb because usually they listen to the smart money after the smart money's made its move, right?
Right, that's absolutely correct. And I mean, the smart money, they have advantages, like they have lots of experience. They tend to have better research and better information. And, sometimes that information is inside information. Those are the reasons why they have the advantage. I mean, the retail money is not working with the help of any of those things or instruments.
Yeah, that's just the way it works. You have to accept that. And I don't by any chance consider myself to be anywhere near the smart money but I do know that it's a pattern, and I've seen it over and over again. And this time, once this thing gets going, it's not unreasonable to assume that gold's going to set a new high, a new nominal high, I should say, and it's going to be above the prior high of around 1950, which was intraday, so it means less, but it was still a high.
Yeah, and I just wanted to make another point in sync with that. I mean, if you look at how bull markets operate, I mean, as far as the gold bull market, the resources bull market, we're 12, 13 years into it, depending on, whether you say it started in 99 or 2001. But generally, bull markets tend to average about 17 years. So, I mean, judging from history, you would probably expect this bull market to end. I mean, it could end 2017, 2018, or thereabouts. That's kind of what I'm thinking at. We're almost in 2013. And what I'm trying to say here is in bull markets, the most gains tend to come at the very end of a bull market. I mean, a friend once told me that 20% of the gains in a bull market come in the first 80% as far as time. And then in the last 20% of the bull market, in terms of time, you get 80% of the gains. So we are really setting up for, I don't want to use the bubble or mania words, because I don't want to, I don't want to sound like I'm taking it too lightly, but, looking at all of these factors, I mean, this market is really in position to develop into a bubble. And how I think that's going to play out is, we're going to see a much stronger resource sector, especially precious metals, probably in 2013. It's probably going to start to move higher in 2014 also. And, at some point there, we'll probably have another correction. But again, I mean, just looking at where we are in this market cycle, we're much closer to the end than to the beginning. And the fact that we've kind of, we had the sharp correction in 07, 08, and, we've had a correction in the last year and a half or so, or last year. This kind of stagnant period that we've had in the last 5 or 6 years, that's what you need in the middle of a bull market, because then all of the weak hands panic out. It's the professionals and the real believers like us who stay in the market, and valuations come down, and we're seeing that on the shares. And all of those things are what puts the market in position to have that parabolic move, to have that bubble in the final phase. And just to conclude, I mean, like I said, we're almost in 2013. I mean, this bull market is not going to go on forever. I mean, we're perhaps 2/3 of the way through this, or even sure? 3/4 of the way through it.
You sure it's not? I thought it was going to go on forever. Now you're really upsetting me.
Well, I mean, I guess all good things come to an end, so we can't count on it going on forever. I mean, at some point, the price of the metals will be. Silver is an industrial metal, and so there is a supply-demand component there, where when silver gets very high, I mean, it's going to bring on a lot more production. And with regards to gold, when gold goes above the price that's necessary to back the entire monetary base, that will give you an indication that we're probably months away from the end.
Yeah. So at some point it's going to happen. But we have further to go, and a lot more, I guess we should say, a lot more gains to occur as well.
Yes, absolutely.
Yeah, I don't think there's any question about that. So, Jordan, we got to wrap up. If you want to find out more about your work, what you're doing, where's the best place to find you on the web?
thedailygold.com.
All right, thedailygold.com. We've got a link someplace on the site to it. And we'll have this, as well as many others, interviews that we've done at financialsurvivalnetwork.com. And Jordan, always a pleasure. We'll talk to you again soon. I have a feeling the move, I just kind of feel that it's coming. There might be a couple of little dips first, but I think the lows, maybe they'll be retested, but I don't see anything stopping this.
Well, Kerry, thanks for having me on. It's a pleasure, and I absolutely agree with what you just said there.
All right. We'll talk to you soon.